Welcome back to the final hour. It is March 26th, 3:04 p.m. Eastern Time. We have hit a halt in this little bullish recovery, and the market's come back to test that gap from Friday to Monday. So my question is, are the bears readying up? Are we going to maintain this 200 EMA level? We're about to find out. We still have the end of quarter on Monday. We have Trump tariff conversation April 2nd, kicking off the new quarter. We also have core PCE on Friday, GDP Thursday. So there could be some news to keep this thing afloat. But today was probably not the best looking day for the markets as far as this recovery. Now that being said, it was a good short term recovery. We did pull back to around the 38% zone, and I just took a high to low swing, and we pulled back to the 382 on the SPY. We pulled back to the 382 on the SPX. You look at today's candle, this looks like a pretty textbook evening star, and this is coming back into the gap from Friday, Monday. So now the real question is for Thursday, Friday, will the bulls keep this alive, or is this the bears reclaim back below the 200 moving average with room to try to go back and grab these lows? I don't know. We're about to find out. Typically Thursdays, Fridays try to form some highs. This week would be a high on Tuesday. Today we just slowly, painfully slid lower. We got 1.35% down in the S&P. We have over 2% in the NASDAQ right now. The Dow is down just over half of 1%. Russell is down over 1%, 1.35. We got the VIX rallying today up 1.6 points or 9.3%. We got the VIX one day up quite a bit higher today. VIX one day is up 4.63 points, almost 38% on the VIX one day. Currency strength. We really don't have a ton of volatility on the currency side, which is a bit surprising. It has been a slow grind to the downside. This is my 5-minute chart. This is the gap from Friday to Monday. And so our Monday rally, our Tuesday continuation, and Wednesday pause, didn't break the highs, and then we've just been sliding all morning. So point wise, 57.80 down to about 56.90, so nearly 100 points on the day. It was, it was fine for some early selling in the morning. That was fine. I was trying to get some sell premium. I had like a bear call spread up here around like 30 to 40 cents. I just thought it was an unnecessary amount of risk, so I didn't end up taking the trade. I do have a butterfly that I'm looking at a pending order, but it's so late in the day now at the final hour, it's unlikely going to get filled. So most likely this trade unfilled for the day. So I don't have to do anything. I guess I can just cancel them. I'll just cancel them. They're sitting at like 0, and I was trying to get filled for $1 or $2 credit. Not going to get filled. So tomorrow's a new day. Is it possible that the bulls step in using this area here? Maybe use today as a little bit of a trend line. The market could show some vigor and some support in here. If so, maybe a little comeback trade to rebalance what was a slide for Wednesday. Or it could get worse, right? I mean, this gap could be completely filled, and this would be a slide. If the market doesn't respond, I would say by filling this gap, then I'd be a bit more concerned to hang on to these gains through the end of the quarter, which is Monday. So, going to be interesting. Tomorrow's news, we have GDP in the morning. I think unemployment claims as well. So, not a lot today. We got President Trump talking. I'm not sure what he's talking about. Something about, is it about auto tariffs today? I thought that was going to be delayed. I saw this headline this morning. Tariff coming in April will probably be more lenient than reciprocal. But at the same time, if Trump and co are trying to pass some major tax cuts, they're probably going to have to do it with a blistering bearish market, which could be really ugly. So I just think traders need to be braced and buckled up for some ugliness ahead. If that ugliness is something to this effect where this evening star just quickly rolls into another continuation Thursday, Friday this week, and we're right back where we started, do we end the quarter near the lows, or do we end the quarter at least fighting back? I don't know. So I'm not just saying that I'm not just giving up and saying the Bears win. I did put some hedges in. So when this market did pull back, I was adding in some hedges. I've taken those hedges out to August. and I've taken those out to September, and I've taken them out to December. On Saturday this weekend, I do have a webinar about strategically, tactically putting on hedges in the portfolio to protect some downside. I put on a trade today. Max risk is about $950, and potential profit, unlikely going to be realized, but potential profit up to $44,000. So realistically, if I can take that $950 risk and gain $3,000, $4,000, $5,000, I would be pretty happy with that overall. So something to consider. And I'll be doing a webinar of that on Saturday. If interested, if you're in my Telegram channel, that will likely pop up, and you can jump in and join me live. I believe that's around noon on Saturday. Yep, noon on Saturday, 12 noon Eastern time. So any of my members can ask. It'll be in my Telegram channel. So let's go. Let's zoom in for just a moment here. High to low on the S&P, pulled back right around that 38% zone, and it's topping out with that bit of an evening star, which isn't a great look for the bulls, right? That's a very textbook candlestick pattern. We go to the Nasdaq, same type of thing, gap higher, a little indecision or poke. It was just shy of the 382 on the Nasdaq. Here's the NDX, just shy of the 382 pullback. The Qs also bullish, indecision topper, and then decision today, still shy of the 382. The Dow, another pretty ugly candle. Dow started out actually high on the day, actually went higher on the day, and then dropping pretty firmly again, coming back to maybe retest this gap. Now, Russell is kind of in its own, I mean, you could argue that the Russell's in a bear market right now. We have 20+% from peak to trough. That's a 19.6% correction. Call it a bear market or not, but I don't like any index being down 20%, 19.6% to say like, oh, it's not a bear market. It's not looking good. So I do have this trade. I closed for profit. I have this trade still running. Nope, I closed it for profit. Never mind. So I only have IWM remaining with a covered call. I think that's all I have for my IWM. Also, I closed out gold today for some winners. Looks like I have one account still running. This account's still running. Yeah, I'm going to close this out for a little bonus trap today. Let's see this. Let's try to get 40 cents here. 30 cents. I had 20 cents earlier. So 20 cents, that's the only increment I can get. 20 cents bonus profit. Okay, good. So $1.40 turns into $1.20 turns into $1.40 on that gold trade. That's good. That was a nice little winner, little income trade. And I wanted to look at IWM. Took a winner today on Chewy, took a winner today on GameStop. IWM, all I have remaining. Anything? Nothing? Oh, there it is. Shares and cover call. That's it. Okay, so that's all I have. I'm about 84% profit on the covered calls before I looked. I mean, I can roll them if I want to. I can roll them down. My break even's like 197, 196 on the Russell, so it's not a bad spot to be in. But I also want to consider if I take the profit on the covered call, then I may just be looking to create a collar trade so I can have some downside protection in case we're about to go lower. So I'm looking maybe 30 to 60 days out in some of my collar trades. We've had a decent slide today, so I'm red for the day. It's fine, but it's been a heck of a battle. This week I've closed out. I'm trying to think, probably over 120 to 130 trades this week for profit. So that helped kind of pad the bottom line, get a bunch of cash back in the account, reduce the buying power, or actually increase the buying power, so I have lots more cash to work with. This was down to about 900K, now it's at 1.47. So that's good. I mean, that's been helpful, and I'll continue to kind of monitor things carefully, putting on some hedges. So futures hedge, this is a play in copper that is it's pretty much at full profit. This expires in April. Silver still doing very well there. This expires today at the end of the day. So I should have another $900 of profit rolling in on silver today for a futures contract, and that's about it. So all right, let's see here. Still catching up. What are those pink levels? Okay. So pink levels that I have in the software, this is providing liquidity levels. And so what I showed real time this morning, traders, my daily profit play, we discussed this. We did have the SPX that was looking to go down towards about 50. I think I called out around 5,700 today. 5,700 was my level as the day started, but it was an interesting conflicting signal because I had the SPY looking to go up towards 570 and nothing to the downside, and the S&P or the SPX had a large level here at 5,700. So SPX ends up winning for the day. And the only problem I had as far as day trading is I wanted to sell more premium. I just didn't get the premium with a IV rank that was a little bit lower than what we've had the last few weeks. So I initially, when we started to sell off here, I was like, well, if we just hang out and maybe chop around for the day, I can't really go high enough to sell where I want to. And so I didn't want to take on the unnecessary risk. And also, if we start to go back in, I don't want to say that this is the bottom because the market could certainly come back in and test this gap or get into this gap. And so calling the bottom there would also be a silly trade. So I didn't take the trade. So the pink levels here, this is the difference between a pre-market reading and a real-time reading. So as the day unfolded, these levels started to light up as we were selling off more and more through the 10 and 11 o'clock handle. And you can see here the SPX started to grow in sell premium, started to grow in sell volume, started to go in put volume, and we started off getting the bear side a little edge. Now it's 60-21 for put sentiment compared to call sentiment, and the market slid lower for the day. So SPY, same thing. There is a reasonable support level that we breached. I was kind of watching this level closely because we did have a gap right here. So this gap from Monday's open, well, there it is. And price is right in the middle of it. So this either is a support zone to see if these bulls want to fight back, or this is, good run by the bulls, topping pattern, and the market comes right back down, and we are resuming this kind of flee to safety and probably this de-risking that I've been talking about for the last 2-3 weeks. Get ready for a little short-term rally. We have it. Is it it? Is this it? I don't know. It would be disappointing to see that that's it, but I do think the market has to be braced for more turbulence ahead if we are going to see just an ugly path forward. I mean, that path forward would be if we bring on chaotic conditions, almost like a recession. Okay, maybe not wanting to keep a recession around, right? I mean, obviously it's difficult to go into a recession without having some type of plan. But if we go into recession and think about, and I'm not here to talk politics, but it's like, think about what the administration is trying to do. They're trying to weaken the dollar. They're trying to improve some type of trade status in the world to make it more mutually beneficial, and just make imports, exports, and trade deficits go down. So we're cutting government fluff. We're cutting jobs. Jobs probably should not be the hatchet or chainsaw approach because that sentiment leaks into government jobs, that go into private sector contracts, that go into the peripheral jobs. Like we could see a big jump in initial jobless claims. We could see a big jump in continuing jobless claims. That fear and unemployment can certainly penetrate the markets. If we start to see trending higher data, that could be a problem. So Thursday, for example, with continuing jobless claims or unemployment claims, do we see like a big spike up in that? I mean, the federal workers have been paid off through September. So realistically, like that data won't show up until later this year. So I think if there's any resiliency, now's still a good time. But if we're going to see the pain train this first half of the year, I just think traders should be willing to acknowledge that downside could get a little bit nastier. So, I've been warning about this, but watching this April low, this August low, we kind of came back in to test it. So the nice part was we came into it's not open interest. It's a combo of things. It's a combo of like readings on the option chains. So we have like lots of Greek flows. We've got open interest levels and volume. It's an aggregate score on like 40 different option chains. So it's a patent pending system or software. Anyway, so we're above the 200 moving average, but we are moving back below it. And I think the concern going into Thursday, Friday is if we don't hold this 200 moving average here for the end of the quarter, the bears can easily get the upper hand. And that doesn't look great because we did see a couple rejections. The market ripped up higher. And is that it? Like you pull back 38% and this market is ready to drop. I think the scary part would be, how far this could drop. And I'm just saying previous all-time highs, 20% area, outer trend line. And if this is a 382 pullback and this is a recent high, if we start going lower, no joke, this thing could scream through 48 and come all the way down to 45. Now, at this level, I would be buying aggressively. At this level, I'd be buying aggressively. But I hope that this is not what we're about to deal with. I mean, it will offer an incredible opportunity if you can survive it, which is why I have some very asymmetric hedges on, because if things get really nasty sooner than later, then my August, September, December, it's plenty of time to make sure that my buying options won't necessarily be decaying too aggressively. And that swell in volatility and that swell in premium will make those very profitable. But all that is to help offset some of the risk and allow me to build back with a nice chunk of profit that doesn't require me to get back to all-time highs. Okay. So recession talk. Here's Lee. Would you say talk of recession is just market noise? I mean, it's not market noise. I'm seeing some very smart macro analysts out there calling for higher percentages of recessions. Look, I've seen the bear porn. I've seen the wall of worry. I've seen people that are calling for the end of times. It's not that situation. I think. Look, if you think back what this market's done over the last 25 years, take the dot-com bubble. Okay, so you got your roaring 90s, you got your dot-com bubble, the market crashes, takes a while, crashes again in 2008. Then we have the greatest bull run we've ever seen with some hiccups along the way. But there is a Fed put and there is a Trump put that this market will see at some point. My issue with that is I don't think this is the low. Everyone watching this decline is saying, hey, what's the Fed going to do? Nothing. The Fed isn't doing anything right now, and they're not going to do anything, right? And Trump is not going to do anything. Trump does not want to talk the markets up higher because that is inflationary. So we're going to see that you have an administration with a majority that probably wants to see lower equities and lower, worse conditions in order for the Fed to be pressured to then start cutting rates and being more accommodative. And as we talked about these last, couple weeks with the US 10-year yield, this 10-year yield is not budging. All right. So, what is a major refinancing barometer? The 10-year yield. You want to buy a car, you want to buy a house. I just got off the phone today with a mortgage banker. I'm looking at services between 10, 12 different servicers on my loans to buy a house that I'm closing on in mid-May. And right now, it's about best I can get is 6.5% with no points. And then, I mean, there's some programs and there's some ways I could do buy downs, but I also could get some complimentary refis in the next 5 years or something. But my point is, if this is going to be a gauge for businesses need access to capital, they're not going to refi at 6%. They're not going to refi at 7, 8, 9%. All right. So if this is driven lower, how does that happen? Well, remember, the Fed cut rates right here and the market did the exact opposite. Okay. The Fed hasn't done anything. All they did was they cut rates September, November, December, and the market finally topped out as we rolled into the year. But what just happened? We've seen a decline in the market. So the market drops and the 10-year yield goes down. The market rebounds and the 10-year yield is sticky. So if we're going to see this go lower, we probably have to see another leg lower in the markets. It's that simple. It's going to suck if that happens. It's going to suck if it happens sooner than later. I think the only benefit would be that, yes, things get cheaper to borrow, right? If you want to refi debt, if you want to buy a car, buy a home, things look better. But if people lose their jobs and people are scared and pissed about the economy, then we're going to easily slip into a recession. Now, I think a recession could be short-lived. I'm not saying we're going to have like a COVID crash type situation again, but the amount of money that was thrown into the markets in 2020, I don't think we can do it with that. Similar to what happened in 2008. We bailed out banks with like $700 billion. Okay. What was COVID? 2 or 3 trillion dollars. So what would it be now? 5, 6, 8, $10 trillion. Like, what do you do? So I think we've got to be very careful. I don't know how much pain there is. I just think that investors are silly to think that this is it. I mean, there's good indications that. So why could we paint a positive picture for the year? Well, resiliency in the economy. Okay, fine. The consumer is not really as bad off as what everyone thinks right now. So it's more of it's a contrarian sentiment indicator. If GDP comes in solid, it's not that like Atlanta Fed revised negative growth GDP. If we have jobless claims that aren't spiking like crazy, we've got a core PCE that's showing okay, like it's steady or even trending lower. That gives the Fed maybe room to cut, which they're planning on doing this summer. And the wall of worry can continue to get climbed. But the wall of worry, if this market finds a way to climb this wall of worry, I hate to say it, but I'm going to be a bear at these tops because I do think this market is long overdue for a bigger correction. So either this is going to bring on some pain and we have either a bear trap where the market responds from here, okay, or we are going to see some more damage, some more damage, some more damage, and it's not going to be pretty, and it may not be perfectly technical, and it might be really ugly. I don't know, right? That was ugly, and then it wasn't. This was ugly, and then it wasn't. But I don't think it's the same move. We had support here. We had support here. This one, we breached a major technical buy zone. Breaching that 200 moving average is a big deal. And if price stays below that, the famous death cross is what everyone's going to be watching, right? If markets are pushing lower and this 50 period is going to cross over that death cross and where prices are at is not a good sign. That would be what is a rally is sold again, and a rally is sold again until this thing actually finds a low. And so, I mean, as far as me being a bottom picker, I don't think this thing is going to bottom in August lows or these April lows. I think it takes all of those out. I think we bottom somewhere between 4,800 and maybe even 4,500. And that is a very painful start to 2025 if that's what we're about to see. So I hope that's not what it is. I really do, because it's not going to be fun. Will I figure it out? Will I grind through it? Sure, I'll be fine. But it's not going to be fun. I can promise you it's not going to be fun. I don't care if you're a permanent bear right now, it's not going to be that much fun, because you're going to have like tons of liquidity that's running for the exits. Your bid ask goes super wide. Yeah, I mean, if you're just buying puts, cool. You'll get an incredible amount of profit potential. But it's never easy. Timing this thing was not easy. I mean, I talked about an easy like 7-8% correction. We ended up going right around 10%. It was pretty nice, right? It came right back in line with this yellow box, which I had drawn out for the beginning of the year, saying if we have a correction, this is where I'm looking to buy, and I did. I nibbled. I closed out 120 plus trades this week for profit. That's great. But if there's more downside, that's why I have cash at the ready. I've got to be watching that pretty carefully. Okay. All right. So to answer your question, Leon, talk recession. Like I said, I see some smart macro people that are talking about higher percentages in recession indicators. There's a couple that I follow. Darius Dale from 42 Macro. He's actually changed his stance from being a cautious bull to now a pretty much sounding the alarm bells to be a bear. And that's pretty aggressive because he's not like a bear porn guy. He's a macro guy, and he's been pretty accurate. He's not getting the tops and bottoms, but he gets the line shares of the move. And yeah, he is now looking at, if the market is going to deal with some more pain, it looks even gloomier into like September, into the end of the year. So I don't know how the seasonality works. Typically, we see like a little pullback in March, and then the market stabilizes. And then in April, May, June, July, the market finds a way to rally. But I have no idea. Is this a nasty first half of the year and then a better second half of the year? I have no idea. I don't know. So I think the best thing to do is don't take crazy big trade sizes. My hedges are very cost effective. They're typically a quarter to 1%, or I'm sorry, a quarter of 1% to maybe even up to 1% if the asymmetry is there. Like I said, I'm risking. I mean, what's $44,000 max profit for $950 risk? I mean, that's a 40. What is that? 4,600% potential profit. I mean, I don't think that's going to be achievable. But if I turned $950 risk into $5, $7, $10,000, I would take that in a heartbeat. That would be a very cost-effective hedge. So anyway, okay, makes sense. Like I'm legitimately concerned, right? I think that price action for Thursday, Friday will be really, really important to see. If today the Bears get their groove back and they're pushing back below the 200 moving average, that doesn't look good coming into April. So unless Trump is very soft on April 2nd, which I don't think he doesn't have any reason to be. If he wants to pass an aggressive tax cut, it probably needs to be at the pain of the markets. So it's going to be ugly if that's the case. So where does that mean we are? I don't know. But I would imagine that if we are in, hey, Fed, what's going on? What are you guys going to do? The market is breaking some massive, massive support. And it's no longer like the Fed can just sit and wait, sit and wait, sit and wait. The Fed is going to have to probably consider doing something. So the issue with April is there's no Fed decision. They have minutes only, but there's no Fed decision. The next FOMC is May. So I don't know if they would come in and do some emergency anything. I don't think they would. But believe me, if that is the case, the market's going to be begging for it. I just don't think you step in the way. I think this market has a lot of room to fall. So buckle up. It could be very unpleasant, and all this could be planning for the best, but preparing for the worst. And if I can come out ahead and profitable, preparing for the worst, so be it. Because the pleasant surprise would be that it doesn't go any lower and it just keeps resilient and it just gets this like little seasonal flow and we pull back into more equilibrium here and the market's not done. That's fine. That is a pretty easy recovery, but I'd still be concerned we have another flush lower. But with today's candle coming right back down to the 200 moving average, if Thursday, Friday fills this gap and closes back down into this chop area, April comes around, we could easily poke those lows. So I'm just saying, like, be ready. Be ready for the next couple weeks. It could be another chunk. All right. But price action will be key. So, every day we talk, it's going to be some really important levels. It'll be some intricacies. But I'm watching, the S&P and the NASDAQ, the Dow, the Russell, and, how are we comparing with the overall markets? I mean, take a look at the heat map today. Everything is red, right? Not everything, but, 73% of stocks declining today. Here has been the advanced decline for the day. So, I mean, we started out roughly higher and we've just been fading all day. So S&P down, advanced decline line down. Volume has been favoring, bearish volume has been increasing all day with this thing going lower. And yeah, it hasn't been a great day. So that's where we're at. Okay, for the heat map, looks pretty ugly. Tesla down. We're at 269. We're down 6.5. I mean, Mag 7 again. Harder rotation out of Mag 7 again. Okay. Everyone that's been cheering on this like Mag 7 rotation, I wouldn't cheer too hard because if the Mag 7 continues to, get beat up badly, these are so big with market cap weighted instruments like the SPY and Qs, they are going to drag those indexes lower or those ETFs lower. Now, what is performing today? Well, we have, 27% of stocks advancing. What is it? Consumer defensive. Pepsi's up, Coca-Cola's up, Walmart's flat, Procter & Gamble, Clorox or Colgate-Palmolive, MO. I mean, this is Philip Morris and Altria. I mean, consumer defensive. So there's some low beta, low volatility dividends up here if you're looking to hide out and be diversified. Energy's not a bad place. You got some energy. I'm long Chevron. Utilities. I mean, utilities are always interesting. Like XU is a pretty good way to trade it, to have kind of the basket exposure, but utilities are, again, lower beta, lesser correlated, and good dividends. So they are high like debt companies, but utilities will be a big factor if we are going to have some recovery towards like AI infrastructure towards the future. This energy demand is, I mean, it could be exponentially higher than what we're capable of right now if we're going to build out this crazy AI empire, So anyway, that's where people are hiding out. You've got utilities, you got consumer defensives, you got energy, and you got healthcare. Those are probably your best sectors if you want to be diversified away from growth, momentum, and Mag 7. Does it guarantee you're going to perform well this year? No, but they could suck a lot less. So if they are flat for the year with dividends, you could still net something, and you could avoid some of the potential, growth and momentum headaches that would be sliding this market dramatically lower if that is the case. Okay, all right. So that's what I see. So tomorrow and Friday, we'll watch price action closely. VIX, like I said, VIX one day is up a lot. That's a big spike in VIX one day. Here's the VIX back up with it. I mean, that's a big rip. So we had this nice little settle about 9 to 10 candles to the downside, and volatility today takes another spike up. So, I mean, are we about to see? And again, this might be the start of like what 2022 was like, which is we had a persistent rip in volatility, and then a fade, and then another persistent rip in volatility, and that was a lower low in the markets. So if we get back up to these same highs, we're probably making lower lows in the markets. and this will start looking a little bit like 2022. Difference is, the Fed is in a phase where they're looking to cut rates as opposed to what they did in 2022 because the market was deleveraging with the Fed raising rates. But this was the persistence, right? We have a run up in the volatility index, and it comes back down over like a 5 to 10 day window, goes back up, comes back down, goes up again, comes back down. All these, by the way, were as we're making equal highs in the VIX, we're making lower highs in the markets for that entire correction. So anywhere between about 25 and 35% corrections in the S&P and the Nasdaq. And that did last. I mean, that was a 9-month correction. That was not fun to trade. Not fun to trade at all. Okay. So, I mean, this is why I trade with a lot of defense. This is why I think trade size and risk management is the most important thing. This is why having forced cost of doing business hedges is important to make sure you can kind of maintain some type of equilibrium in your portfolio. It does suck to waste. If I do a quarter 1% a month, or give or take like quarter 1% for 12 months, I mean, I might sacrifice 3% of my total profit, right? But 3% in total risk to make 10, 12, 15% gains, that helps offset a lot of pain that this market might be going through if it goes through it, right? So to me, that's worth it. That's worth the cost of doing business to, have like 400 or 500% upside gains if I get them. So yeah, it's going to be interesting. Tomorrow's news: GDP and jobless claims. I think in the morning, 8:30 a.m. Eastern time, right? So tomorrow morning, final GDP numbers come at 8:30 a.m. Unemployment claims. I mean, they're forecasted to be nothing crazy. Final GDP 2.3. Are they way off? I mean, if this prints like a 1.5, is that a big miss? Is the market going to slam it lower? If they print about the same or come in as forecasted, is it okay? I think now it's like, bad news is bad news. And then Friday is core PCE. Same thing. Is bad news bad news? We've got 2 days to find out. So if the market can fight back a little bit, okay, we'll see if we can just finish the quarter without hemorrhaging too badly. So I'd like to see the market show some stability. But that news in the morning, the nice thing is news in the morning. This is probably my least favorite, is when we have 10 o'clock news, right? So news in the morning, let's see what the futures market does tomorrow morning. Is it good or bad? How's the futures market interpreting it? And then Friday morning, same thing on core PC. Is it going to be a mover at all? We did see trending inflation data, PPI and CPI going lower this month. And that was encouraging, but we had a little bit of a rally. Those CPI and PPI data came in mid-March, so we're a couple weeks removed from that. But core PCE, that's the Fed's preferred gauge. Is it the same? I'm also watching the year over year, which if I go to the Bloomberg calendar, do I use no, typically not, because you got to time inverse ETFs really, really well. I don't love inverse ETFs at all, because if you don't time them well, you can't do inverse ETFs and hold them very long unless you're doing the single leveraged. But a lot of traders like to do the double and triple leverage the ETFs, and those are very, very tricky. You have to time that within probably 2 to 4 weeks to get a double or triple leveraged inverse ETF to pay you what you want. If you don't time it well enough, you don't make money. So I usually just trade options. I trade options on ES. I trade options on MES. I trade options on SPY and SPX. I trade options on all the major index options I will trade. That is, to me, a cost-effective way to plan my hedges. Yeah, I've done the inverse ETFs in the past, and I actually preferred the single leveraged just because it's tick. Because the other ones get repriced, like in expirations, they get repriced, and they're not meant to be held long term. So, and it's very difficult to time the market that way. So I can go out to August, September, November, December, and I can put on like these out of the money, very inexpensive hedges. And if I'm right, I've got a nice window to be right. Right. That to me is better than like I got to time this thing and be nailing this thing for the next 2 to 4 weeks and hope I get it right. To me, that's a price sensitive, time sensitive instrument. All right, let me go to Friday's news for the expectation. Again, I'm going out to Friday, but I want to see if the core PCE has a year-over-year forecast on the calendar. And still, PCE for the year-over-year doesn't have a forecast, and the PCE core doesn't have a year-over-year forecast. So all it's going to have is a previous print, which is 2.6, and I'm curious what this is right here. and we had a PC price index year over year. Previous was 2.5. So I'm curious what this is on Friday morning. Is it the same or is it lower? Lower is good, right? CPI went lower, PPI went lower. If PCE goes lower, that is good. If we're the same, okay. If we're higher, probably not great. And the quarter ends on Monday. So we could have another like interesting wild weekend where the market does something Sunday night. Who knows? I don't think anybody coming into trading this year, any savvy investor would have said 2025 is going to be easy. I didn't think it was going to be easy, and so far I've been proven right. I don't think there's anything about what's going to happen in the next 30 to 60 days that's going to feel easy. I am braced for more downside. I'm trying to protect my portfolio. If we keep going up and we have these little seasonal melt ups, that's fine. That makes it a little bit easier. But I just want to make sure I'm not getting beat up too badly on another swing lower. Okay. All right. So we'll watch the volatility index closely. Let's talk dollar index. Dollar index is getting a bid today. I think this is another agenda for the Trump administration that would be driving the dollar lower. You want to see improved prices for exports and imports. You want to see a reduction in trade deficits. You got to see a weaker dollar. I think an easy way to play this weaker dollar would be watch this 4-hour chart. Okay, I'd actually like to see this area. If we come back up to this 200 moving average and then start to roll over, I think getting a trade in here and potentially even having a back of the trend line retest. I think either area as in we break the trend line and enter 1, or we come back and hit the highs again, entry 2. But I would say my stop loss would be I don't want to see price really going above this area here. So this last low, I want to see price staying below that to make lower highs and lower lows. So what I thought was interesting on this is dollar-wise, if this dollar starts to go lower, the markets were falling as was the dollar, which is usually not the correlation that we see. Usually, if the dollar is falling, the markets are rallying. So it will be another interesting kind of a broken correlation if the dollar sees another leg lower and the stock market also goes with it, right? So I think that the dollar is likely going to be a better place to be looking in the currency world to short the dollar again. I'm just looking for a nice clean entry. If it starts to roll over, I wouldn't say that that's the perfect entry, but it's a place to take a bite. So this is probably what I'm doing on the dollar pairs. Euro dollar is probably my favorite setup right now to trade dollar index. Just trade the euro dollar. So if we come up to this 200 moving average or a little bit higher, I'm just going to wait for a nice clean trend line. If it breaks, I'll take an entry. If it pulls back, I'll take an entry. Okay. And I'll probably go 1 or 2 ATR higher for a stop loss and just trade 1 small, 2 small, and then stack some orders lower to see if this actually does break the lows. Because if I get that right, there's another, decent wave coming, and we have lots of support back here, plus that September, October breakout from last year. So that could be a nice asymmetry trade where you get a couple of entries in, stack some sell orders. That could be sell stop orders, and you can hit a nice win by like the 101 handle. And I don't know. I don't know if the Trump administration is trying to get this thing down to, freaking 90. Are they trying to break for the first time in a long time? Are they trying to break some major multi-year support? Maybe. What happens if they break this low? Well, you look left on this chart, the next low is all the way down here to 90. So is this a high, low, lower high, lower low? And then there's another like wave coming? It's very possible. So dollar could be a big story this year for trading currencies. The nice thing is, a lot of money can be made in the currency market if you get it right. Euro dollar, if the euro dollar offers up a chance to get long, we've got a decent pullback coming right now, okay, which is fine. But I would be watching this for anything in here starting to turn. Anything in here starting to turn. It's not ready yet. Okay, it's not ready yet. But anything with an aggressive trend line on a lower time frame, getting you a turn, taking an entry, small, and if it pulls back, take an entry. And my stop area would be probably back below 104. As long as we don't breach 104, then I think this euro dollar finds a way to go higher. That looks like a good area to be building in for some small positions and then stacking up. If price just goes higher, stacking up some wins towards that 112 handle. So I will be watching euro dollar closely to trade it. Okay. All right. What else? We have some currencies. Somebody asked me about yen pairs this morning. good. I mean, I don't want to trade the yen. I think the yen is possibly going to unveil another rate hike this year, possibly another leg like we had in July to August last year, where they basically deleveraged the entire market. That was certainly a scare. I'm curious if they do that again this year. So it's not ready yet. So far, these lows seem to be holding, but would anyone be surprised to see this market either in the near term come back up to these levels, find resistance, and then sell back off? I wouldn't. I mean, we're sitting at the lows, right? If we break the lows, just follow the trend because this is high, low, lower, high, and we're just going lower. Measure symmetry. We got lower levels. And again, if Aussie yen is going to sell off, usually the correlation is a weaker stock market as well. This is a good risk on, risk off currency pair to follow. Aussie New Zealand. I'm just going to level into this one. I'm not really worried about it. Aussie dollar, I'm out of this trade that was a small winner with this little dollar move. CAD Swiss, I'm adding. I've got a bunch of trades in CAD Swiss, and I'm adding, trying to take profit towards 65. CAD yen, same thing. We might pull back into this like 110 handle, but if it breaks lower, high to low, lower high to lower low, if it breaks lower, there's room to get there. I mean, that's a terrible entry versus if it comes back up to the same highs, well, we can look for confirmation to sell there, stop loss above, and then go back down to the lows. If it breaks the lows, you get a huge profit potential. But I don't see a compelling reason for me to be shorting anything yen related because I don't want to take the paper cuts every single day for financing and negative swap. So I'm trading FXY. If the JPY gets stronger, this is what I'm trading. I own shares of FXY. I've owned shares since $58. I will continue to own shares. I wouldn't be surprised if my $58 position ends up going back up to these highs around $66. It's not a big winner, but there's no financing charges. So if I could get $8 a share on 1,000 shares, well, that's good. I can make some money. That's a little bit of a hedge that I have for this year. Okay, all right, back to some currencies. Let's go Aussie. We went to CAD Swiss. Okay, let's go Swiss yen. Staying out of it. I closed out for symmetry, but not. I mean, we hit the same lows. I closed out for 560 pips. I'm not in this trade anymore. Euro Aussie, maybe a fib. High low, lower high, lower low. That's it. I'm not trading it. Euro CAD steadily dropping. I'm not touching this thing. I was looking for a pullback in here, didn't get it. Euro Swiss, I'm getting pullbacks. I'm still going to add in. So I have about 4 positions in right now, with a potential 5, 6, 7, 8 positions more to add to the 20 plus positions that I already have running. Euro pound, no trade. Euro yen, I don't know. Watch this one for some resistance. If we have resistance here, I could see the euro yen heading back down to the lows if things get a little nasty. Euro New Zealand, similar to Euro Aussie, high, low, lower, high, lower, low. Find some equilibrium. Euro dollar, honestly, one of my favorite trades in setups right now. I'm not in the trade yet, but I think one of the better looking setups. If we come back into this as a buy zone area, I like this euro dollar as a chance to get back to 112. So I'll be watching euro dollar pretty closely. Pound Aussie, no trade. Pound CAD, meh. Pound Swiss, I'm still long. Pound yen, nothing. Pound New Zealand, no. Pound dollar, I like euro dollar better. I don't like the pound dollar as far as the technicals go. New Zealand CAD, this one I'm just averaging at lows. 8,000, 8,000, 79, 78, 77. I'm building into these lows, and I'm just going to trade this back at this chop around 82, or trade it back to these recent highs of 86 and 88. New Zealand Swiss, I'm still long. New Zealand yen, no trade. Maybe this double bottom is holding. We head back up into these range highs at 92. That would be a risk on rally, by the way. If this goes up to 92, that is risk on. Similar to Aussie yen. If Aussie yen goes up, that's more risk on. But if we are going to keep going highs and highs and highs that are lower highs, then obviously this could be up and turning lower and turning lower and turning lower, and it gets a little bit nastier out there. So risk off trading, you can see it in the end crosses. New Zealand dollar, I'm out of this trade. I'm just going to wait. Dollar CAD, no trade for right now. Dollar Swiss, I want to see some pullbacks towards 86, 85, 84 again. I'll level back in. This was a nice winner towards 92. Dollar yen, maybe one of the most telegraphed bear patterns that I can see in the markets. If this is a bear pattern in the making, watch your fibs. Watch for your bear patterns on the smaller time frames. And if this starts to sell back off, there's another chunk. It's going to be difficult to time, but this trade could also offer up an incredible risk reward opportunity. So watching closely. All right. that's all I have for currencies. Here are some non-US plays. I mean, things have stalled. Like DAX stalled today. This is Vanguard. That's European. That's European. The one I'm in is SCHY. That's a Europe and Asia-based dividend ETF. So I'm in this for like $25, I think. That's it. This one, that's the true 2-year Treasury. XAR Aerospace. This is an aerospace and defense ETF, which I thought was interesting. And then calf and cows. These are small cap related. I listened to an interesting podcast this last weekend. Not something I want to be buying unless it's down here towards this yearly moving average. There's a lot of structure in here. I could see this entering into a bear market. And once it's maybe over and done with, then yeah, there's a good opportunity to buy, but not now. Okay, Nikkei's not doing anything. Nikkei hasn't done anything since last July to August. It put in a 27% peak to trough, and it hasn't done anything except stay in the middle. So there's not really much to do on it. I have some plays in. Let me find it here. Nikkei is, so there's my Nikkei. I mean, there's your high to low from last year. We're sitting right smack dab in the middle. Nothing is happening. I'm in EWJ, which is back up towards these recent highs. This is a way to eliminate like bottom 10% or the bottom 20% of the Nikkei. So you get rid of some of the laggards. So I have some shares of EWJ, similar to DXJ. But like I said, I trade FXY because I'm long the shares. This is like being long the Japanese yen with no negative interest rates or no swap, and then the Nikkei is still stuck. If we go into risk off mode, I mean, if we deleverage again, I don't know if the Nikkei takes another huge hit to the downside, and then we come out with some crazy radical program for the Bank of Japan. Again, I have no clue. I mean, their index to me is an enigma. Their currency to me is an enigma. I don't love it. I don't sit and wait and hope that I can get the Bank of Japan timing right because it's freaking impossible. So anyway, there's not a play that I like outside of. I'm holding FXY long and I'm holding EWJ long. On a positive note here for the last couple minutes of the day, this is the gap that I was talking about on SPX. So there's our move from Monday. So I think what's going to be important to watch for tomorrow's price action is, are we getting back above this Thursday? If we are back above this Thursday, I think the bulls are still showing some grit, still showing some fight, still showing some clawing back, and we'd see prices staying above those 200 moving averages. That could be a good sign. I think, bulls are a little bit happier here. Bears would be happier here. I'll just put a smiley or a frowny face because bears would be happy and bulls would be sad. If we're going to close below this gap, that would essentially unravel all the gains from this week, which would not be a good sign, obviously. Okay. So point is, if we get back above this area for a Thursday, Friday finish, we could at least end the quarter on a, maybe a somewhat positive note, right? But that is to be determined. Okay. That's probably going to do it for today. I've got some services doing really well. We are sitting at daily profit play is now 34 for 35, a nice little win streak. Waterfall income, we had 16 winners close this week. And right now that brings my total, I think it's 63 out of 67 for the service. And then double ups, I have a SPY. I need to be greater than 566 for a win this week. And that's going to be close by Friday. We'll see if we stay there. And then newsbreakers, I had 2 winners today, and I might take a loss on PDD. So 2 winners and 1 loser. We'll still net out some profits. So overall, not bad. And a lot of trades. Like I probably have taken more trades off in profit in the last 2 or 3 weeks than I have in months, just because I was willing to kind of put on some quarter one exposure, March expirations, April expirations, and I played a lot of premium. I sold a lot of premium during that big swell in IV, and a lot of those paid out really nicely. So, for example, it was like stack QQQs. I did like put, and staggered out my expirations. I pulled in almost $10 of credit. I closed out for $800, um, and I was in the trade for maybe 2 weeks. So stuff like that was pretty nice. And to me, it's more capital efficient rather than waiting until June to get the extra $200. I'm just taking the profit, moving on. Okay. Leah says, I'd be much happier if we have a V-shaped recovery tomorrow. Yeah, I mean, I'm sure a lot of traders would be happy. So look, I don't know what's going to happen. I think on a positive note, we are still hanging out above this 200 moving average. So if we go up here and we bounce off it, if we go up here and we bounce off it, and tomorrow, Friday, we try to get to highs, that's a good sign to finish the quarter. And this is what I said. I mean, it would be almost like too good. It'd be too perfect if the market is right back at the 50% zone coming into April 2nd. It'd be too perfect. But if that is the case, like that, you couldn't ask for a better correction here to get ready for either more melt up or more surprise downside. Well, it's not really surprise if I think I think the Trump administration wants to see lower lows. And it's not because he wants to hurt portfolios. It's because in order for things to pass, you essentially need the country obedient, and you need policymakers to be obedient. You need the Fed to be obedient. To do that, you're going to have to put some pressure on them. And that pressure would be, if this market is falling, hey, look, 10-year yields are down. You guys can cut rates again, right? Inflation is down because people all of a sudden stop spending, right? I mean, all these things could snowball into, yeah, I guess it works. The Fed can cut rates when the market is dropping, but it's not going to be easy. So if the agenda is weaker dollar, lower inflation, lower energy prices, lower 10-year yields, that has to come with probably more pain in the markets. And it's not going to be fun. And I'm sure a lot of supporters of Donald Trump are going to be a little upset to see their 401ks and retirement plans and their investment accounts taking on all this heat. Financial advisors are going to be struggling to stay ahead when they're justifying, like, oh, it's long term and we got to wait it out. It's always their answer. Trade through this crap. It's not easy. But I mean, this little rally right here, okay, I had all-time highs at the beginning of the year in my portfolio, and this little rally right here, I hit all-time highs again. So we barely had a recovery, and I'm way off of that all-time high, and so I hit new highs in the portfolio this year. So that's how active I was as this market was falling, and that's what I have to do. For me to survive this, I'm going to be active all the way through it. It may not be perfect, but I'll trade through it. And wherever the bottom is, there's going to be a lifetime opportunity to, do what most investors do, which is you find a great low and we get back to all-time highs in a matter of years, you make a crap ton of money. But if you don't have the presence of mind or the wherewithal to stay in the market, stay in the game, and have cash ready to deploy, you're going to be in a bunch of pain and you'll have nothing but waiting and hoping that the market comes back. That's not a strategy. So anyway, all right, I'll let you go. We got a few minutes for a closing bell. I got nothing pressing to take into the close. I think that was a good session for analysis. Any thoughts, any questions? Okay. Like I said, if you are interested, so we'll be back to do this again tomorrow. Classes as usual. I am switching my schedule up a little bit tomorrow. I'm going to be joining Graham Lindman in the morning around 10:45 in the morning. And then I'm doing a webinar at 11. I've got another, let me check this here. We'll still do the final hour around 3 p.m. And then on Friday, couple more webinars, but I was getting into Saturday at noon. If you'd like to jump into my Telegram channel, this is free for everybody. We will have, I mean, I post like all course alerts and things that are updated in member portals, any links for YouTube, any, analysis and like blogs and tweets and stuff. I post all that here. So it's just a channel for me to share. I also post videos. Every now and then I step out of the office for 10, 15 minutes and I'll post a video and just kind of recap the day, what I'm looking at. So that's an example here. Anyway, I'll share that. But on Saturday at noon, I'm doing it's an April series essentially. I'm doing it every week, every Wednesday, I believe, in April for the entire month. And I'm just going to teach how I hedge. If you want to learn how to hedge, it can be cost effective. There's a variety of ways to do it. It can be very cheap for a lot of high reward setups, or it can be very tactical and pragmatic for, look, it's defined risk. I'll risk half of 1% to make 2, 3, 4%. And there are technical periods to do that when the market's overbought or oversold, mainly overbought, right? I'm looking for corrections. But there's a lot of ways to do it. So That class is going to be noon is the webinar if you want to jump into the service, and then starting in April, I'll be running that class every Wednesday. We have a lot to discuss. We'll do the entire month of April. So if interested, you can jump in Telegram, and I'll share more information on that on the Saturday webinar. So here is my Telegram channel right here. So Chris Pulver, Telegram. Okay. And by the way, if you join Telegram in general and you get a private message, it's not me. If you join my Discord, you get a private message, it's not me, right? So please like block, flag, report, scam, it's not me. This is a one-to-many. Nobody talks to me in this. I don't talk to anybody privately on Telegram. So it's just a channel that I can share everything. Same thing with Discord. I have a public channel on Discord that when I am posting messages, it's in my public channels. So my free group chat is for everybody, right? You can see right here. I've been following Chris since 2020. I've got some people that are saying, hey, watch out for this profile name. There's imitations all the time. So everybody can talk to each other here, including me, publicly. Everybody can talk here. Everybody can talk here. Everybody can talk here. Everybody can talk here. So I don't want a bunch of sub-channel threads. I want this to be just a very clean, this is a subject, everybody can talk. And then my instruction, if you want to do one-on-one with me, that's fine. Any discounts and affiliate links and referral links I have in the industry, from software to education programs to charts to whatever. Everything I do with, I've been doing financial education now for over a decade, so I know a lot of good people in the industry and have some good deals, and I can save you some money. And brokers, same thing. So anyway, it's just I try to keep it as clean as possible, but still people jump into Discord and they get private messages from me. It's not me. They get friend requests from me. It's not me. It's not me. So I'll show you right now. I'm going to go to my server settings, go into members, and I wouldn't be surprised if we've got some imitators right now. So if I type in real, no, that's not an imitator. Okay, let's go Chris. No imitators. If I type in Pulver, no, I don't have any, so I don't have to comb it. But again, they like hide out in the direct message environment. So just report them, flag them, they're scammers. Okay, and that's why I say here for the rules, read first. No scammers, no direct messages for me. This is my profile. You can find me every single day. Okay, if anybody's doing this live, you want to join my Discord, I'm going to post a link that lasts about 30 minutes. So let's go to invite people and edit. This will be good for the next 30 minutes if you'd like to join my Discord. That way, there's a life cycle to it, and I'll post this in the chat right here. Chris Pulver Trading Discord. There. So Telegram, Discord. There you go. Okay, everybody. I'll let you go. Have a good rest of the day.